Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Hi, everybody, and welcome to the Stock Spinoff Investing Podcast. I'm your host, Rich Howe, and I'm very excited to have Simeon McMillan on the podcast today. I've known Simeon for a number of years, and I was delighted when he started his new Substack, Accrued Interest. We're going to talk a lot about that. What's really cool about Simeon is he is not only a really good investor, but he has a lot of background as an operator in the media space. So we are going to dive into all that and really tap into his expertise vis-a-vis some recent special situations, Starz, Warner Media, and anything else that Simeon wants to talk about. But first of all, Simeon, welcome to the show.
Thank you, Rich, for that warm introduction. Thanks for having me on the show. What they say in talk radio, a long time listener, first time caller. That's sort of how I feel. I almost pulled up my credit card statement to see how long I'd been subscriber, but it's been a great number of years, and excited to come in front of the camera and talk media stocks and talk valuation.
Of course, yeah. I think the first time that we connected was over Liberated Syndication way back in the day, which is of course,
Yes.
podcast hosting platform. So it was fun to connect on that, and then we've been obviously staying in touch for a number of years here. Before we jump into some of the media stocks that I want to talk about and to get your opinion on, I just want to hear a little bit about your background. I know a little bit about it, but I would love a refresher, and I'm sure the audience would love that as well. So, would love to hear a little bit about your background and basically how you came to start Accrued Interest.
Sure. So I'll start with the end and then circle back and let you know how I got here. As you mentioned at the top of the show, my Substack, but also a YouTube podcast and my Instagram handle, sort of all around multi-channel media operation. Accrued Interest is my outlet where I basically publish my research and my thoughts on TMT stock names with a value investing mindset. I do this full time. The Substack is there's currently no paywall, soon to come one day, but I manage my own small family office, my own investing. I'm out here eating my own home cooking, as they say. And so I've been doing this behind the scenes for about a year now. I've gone public with the Substack for the past 6 months, but for about 20 years, I've worked in media in some shape or form. So I was Wharton undergrad. I did the 2 years investment banking out of college. I was in the TMT Tech Media and Telecom Group in Goldman. I focused on mostly television, cable, newspapers, for-profit education, satellites, had a great variety of experiences. And then I sort of did the typical finance path you often see, 2 years banking. I did 2 years in middle market private equity, where I focused on business services, also education, funeral homes, again, a fun variety of Midwestern companies. And then I did 2 years at Columbia Business School when I was in the value investing program, the whole Graham and Dodd experience. And then I spent about 18 months, less than 2 years, at a small hedge fund that closed. The portfolio manager retired shortly, not too long after I had joined. And ever since then, I pivoted into the corporate world where I spent over a decade doing a variety of corporate roles in television, radio, cable companies. I would say my corporate time has been spent in doing a variety of roles, which I'd say, I guess, are called strategic finance. I've done revenue operations, traditional FP&A, and I spent a lot of time working in the office of the CEO type roles. I've supported CFOs and CEOs, division heads. So I've seen it from the buy side, the sell side, and it's fun to be able to evaluate it from an outsider's perspective and hopefully shed some light for investors so they can make better decisions.
That's great. That's a great background. So tell me about your Columbia Business School, the value investing program. Was Greenblatt there when you were there, or had he retired at that point?
So Greenblatt was there while I was there. So um, can't say enough great things about Columbia Raw. If any of your listeners or viewers are thinking about it, it's everything that it lives up to the hype, and I'm not being paid to say that, I can tell you. Um, for those of you who aren't aware, Columbia Business School, like most MBA programs, is a 2-year full-time program, but the value investing program is something that you have to get admitted into while you're there, and it's only the entirety of your second year. So Joel Greenblatt's famous course was one of, I think, about 10 courses you end up taking. Um, it was one of my favorites. One, just to see someone who you have read so much investing books about. I still love You Too Can Be a Stock Market Genius as a book. And what I appreciate about the course and seeing him in real life is that he literally practiced what he preaches. The lectures, I saw someone online was circulating a PDF of, I think, an old syllabus, but it's no secret. What he taught were just old case studies. Each lecture or certain lectures, he would either go to his website, Value Investors Club. He would often pull an old write up. So don't worry if you're not a member or the membership payroll. You can go back into the archives. He pull up an old write up, or he'd pull up a 10K, or he'd pull up just a hated company at the time, and in the most deadpan, simple yet obvious way, just break down why it was cheap. Just one memory that I'll never forget. While I was there, I was in school between 2012 and 2014, and the example that he gave was Microsoft at the time. Microsoft was a hated stock, very much value, left for dead, spoken about in ways I think sometimes people speak about Google today. And he just did his math. It was nothing special, and it was cheap. And you can pull up the share price over the last 10 years and see the rest is history. But Joel, he lived up to the hype. I can say that.
That's so cool. Yeah, I would say, I mean, he's my, I'd say favorite investor to follow. And I love, of course, we've all read You Can Be a Stock Market Genius, and that's my favorite book. But one thing that I love about Joel is that he just simplifies it. He's clearly brilliant, and he's an uncanny ability to make money and to cut through what's unimportant and focus on what's important. But I just love his ability to just be simple about it. And I feel like Peter Lynch had the same approach, reading like One Up on Wall Street or some of Peter Lynch's other books. Just the simplicity is beautiful, because other times you'll hear investors kind of try to hide behind complexity and certain phrases that nobody quite understands. And it's just really refreshing to have, a really smart, really good investor like Joel or like Peter Lynch just be able to simplify it down into a really simple investment case, which more often than not, works out. So that's really cool to hear about that. And then what is the catalyst behind starting Accrued Interest? And, I know you're active on YouTube as well. Is the whole idea to basically just kind of, share your insights and your expertise on media stocks and the media world in general?
Yeah, no, that's a great question. So we've been communicating through email and on message boards. I've been, I think, active in the financial online community for over a decade. And so I always envisioned one day I would go out on my own and have some sort of public profile. I wasn't sure exactly how. What the catalyst, to use an investment term, that got it started was my last corporate job. I was working at a company called MediaCo. They're still publicly traded. I came in with the first management team that came with the formation of the company. It was formed through a spinoff of some radio assets from Emmis Corporation, two main radio assets, Hot 97 and WBLS. And so I came with that spinoff. We had a thesis to buy off the run media assets that maybe weren't getting the full value in the private markets, put them in a public market vehicle. We were going to grow organically through digital. We had lots of really great plans. And for a variety of reasons that might be outside the scope of this podcast, COVID hit, and some of the investment case didn't quite play out. So in 2024, excuse me, I had transitioned out where they had done a merger with a new company, new mandate. So I was looking for a new opportunity, and I decided this was probably as good as time as ever to just start publishing and see what happens. As you mentioned, I started heavy on YouTube. I wanted to try out all the platforms. I started heavy on YouTube to get a feel for it and to also learn about how the different platforms work in monetization. I'm still active. I think on YouTube. I think going forward, my next goal for now and the rest of the year is to really build out Accrued Interest as a research service. I want to be a place where you can go and read about strategy, get regular updates, my takes on companies during earnings season, and then to a much lesser extent, some targeted stock picks. So I went through my whole corporate experience, and then sometimes you just never know when it's the right time to take the plunge. But I decided to just go on a leap of faith, and here we are.
Very cool. Yeah, as somebody who left, I used to work at Citi doing the corporate thing, and as somebody who took the plunge, and I think 2018, it's really exciting to hear other people do that, and it's been fun. I was really excited when you started publishing and you became a little bit more active on Twitter. And then one other thing that I really like about you is that you're focusing in on, I think this is a little bit of a differentiator, is that you're not just like focusing on comps and DCF and valuation and say,
Right.
hey, this is a cheap stock, you should buy it. You're focused more on strategy and how these corporate companies and these media companies, how their strategies play out, what makes sense, what doesn't make sense. And you recently have published a couple articles on Starz, which is a name that I cover as well. And so I would love to switch gears and talk about a couple recent spinoffs. One being Starz. Starz spun off Lionsgate Studio, and the RemainCo is called Starz Entertainment. And I know you published a couple pieces on that. So maybe if you could just walk us through Starz and what your thoughts are on Starz at a high level. And then I have a bunch of questions that I'd love to jump in and discuss. But maybe you could just start us off with kind of a high level discussion of Starz and how you view the company, how its strategy and whether there's a future for Starz Entertainment today.
Sure. So I think. Well, at a high level, I think it's worth telling all of your listeners how far I go back with Starz. So on my Substack, I think my first piece actually talking about Starz was not actually talking about Starz in the present day. I found a copy on my hard drive of my submission application to Value Investors Club from 2014. I'm sorry, 2015, where I was pitching to get membership. I was rejected the first time on another stock, so this is my second attempt, and it was a short pitch on Starz from 2015 because, as your readers probably aware, Starz was a publicly traded company before. It's had different ownership. It's a great spin-off stock because it's lived many lives. So I did a deep dive in what I said 10 years ago, which I think worked out to be the case. So when I did my 10-year look back on Starz, one thing I was reminded was that if you look at the company's history of M&A, the company has been attempted to be sold many times in the past, and over and over again, no one wanted to buy it. In my pitch, which you can find, I reproduced the whole thing. I copy pasted all the words. I gave a little bit of the history of how Starz was part of the spinoff in one of the spinoffs in the John Malone, constellation of companies, and the way Starz and Lionsgate got together in the first place was, I won't go through the whole history, but John Malone, I believe, and some of his lieutenants did, I think, a share swap where I think they had some shares in Lionsgate that they ended up swapping for an ownership stake, I think a minority stake in Starz, as well as some board control. And the reason why they did that was because they were trying desperately not to buy the entire company, not the valuation that the public market was going for. So in the piece, I was explaining how back then Starz was considered a third place in the premium cable channels. You had, the market leader, number one was HBO, number two was Showtime, and number three was Starz. And everyone saw that Starz was number three. Starz had tried several strategy programming changes prior to 2014, they used to have the former CEO, one of the former CEOs of HBO, who built up HBO during the Sex and the City and the Sopranos era. So he came in, tried the whole new originals, tried to create a new HBO, and to summarize, it didn't quite work. So Starz had tried almost every playbook that you could imagine for rehabbing a channel, as well as M&A. And so it was sort of a deja vu. It feels like reboots and sequels are all the rage right now in Hollywood. And this felt like, oh, okay, Stars 3.0. It's solo. I'm sorry, it's independent again. So I laid out all the strategy, and my point was, in many ways, now that we're in the digital landscape, a lot of the perception and reality of Stars, I think, still haven't changed. Now, right now, Stars, I think, has done a great job making the shift from linear to digital. A lot of that, I would say, you can't give them too much credit because their revenue base right now is about 70% digital, but a lot of that is because their linear revenue, that's the money they're getting from the cable company, fell at such a fast rate that all you had left was the digital, which has had some growth. Okay. So they made the shift to digital, but everything else about Stars is still kind of the same today. You have them still viewed as lesser inferior competitor to a more premium HBO, or you can throw in a Netflix or other streaming services. They are trying to market themselves to the investor base as having a new strategy with a new set of shows, and we'll see if that works. So I think Stars is great because it's sort of your own choose your own adventure. I think right now
Mhm.
with the leverage, it's levered about three turns. The equity value can swing with small changes in the enterprise value. We all understand that conceptually. Okay. So at a high level, I haven't published my target price yet, but I honestly think you could justify a target price between $10 to $20,
Mhm.
all because of the leverage. So one thing I like to say on my Substack, and this is how I approach media investing, is my focus on strategy is because I like to say valuation is not a strategy. Capital allocation is not a strategy. I see a lot of stock pitches that start with, oh, this is the multiple, it is cheap, ipso facto, it's going to expand and we'll make a lot of money. And that's not exactly how it happens. I think that particularly in media, the valuation is a reflection of the market's perception of your strategy today. Right now, Stars' strategy is up to be questioned. It's fair to be questioned. They were solo, they were together. Both of those didn't work, and now they're solo again. You could probably say they're not in the best position. So they're going to get a discount in whatever multiple you use. Now, what is the future value of Stars is entirely dependent on how good their individual shows are at the moment. Because since they are a premium network and not a legacy network that has a full slate of programming that caters to all these different demos, they are a menu. Well, I'm sorry, they still have a back catalog of movies from Lionsgate and from Sony, but how long will they still have those deals? I don't know. But what's really propelling the organic growth are these individual shows. So where I come out with Stars, and we can get into the details, and I like to hear some of your thoughts, is that if the current state of shows takes off, the stock is very cheap. It can
Mhm.
easily get over $20. It can go, so much higher. It's a little bit of what's that concept? Reflexivity,
Mhm.
where it's a self-fulfilling prophecy. So if the shows do well, then the stock will rocket, and then they'll become more attractive as a takeout target to someone else. If the shows do not perform, they're never getting the multiple expansion. And in fact, they're actually going to decline at an even faster rate because now that they're no longer tethered to the cable bundle, that takes away the safety net. So they're flying on the trapeze with no safety net, and they cannot stand to have an extended period without hits. So it really is a choose your own adventure. I think that you can come at this a lot of different ways, but yeah, we have to have a wide range of outcomes on this one.
100%. Yeah. I totally agree with everything that you've said. And I think with spin-offs, obviously I cover spin-offs. And what typically happens when you have, and this wasn't the spin-off, this was the Remain Co, but you could view it as the spin-off because it's like
Right.
it's a micro cap versus Lionsgate, which was multi-billion market cap company. You typically see indiscriminate selling pressure once a spin-off begins trading.
Right.
And it can be a great opportunity to buy the stock at a really cheap valuation. But ultimately, the stock has to stand on its own, and that's going to be driven by fundamentals. The same thing that's important for any stock is important for spinoffs: revenue, margins, revenue growth, profit growth, capital allocation decisions. And so I think that that's exactly right. How the stock does is going to depend on how the fundamentals play out over the next couple of years. And one of the important things, obviously, is new shows and new seasons that are coming out. And I want to get your take on some of these shows. I think some of these shows. You said you've been watching some of these shows for like 8 years, and in our pre-call, you said some of the shows are getting a little stale. So I'd love to hear a little bit more about your thoughts on their shows. From my perspective, I think this year could be a decent year because over the past couple of years, they haven't really come out with that many new seasons. They've been impacted, one by COVID, which impacted recording. They were impacted by the strikes that were taking place in Hollywood. And so it seems like this is going to be the first year in a while that they have a really full array of new seasons coming out. So as I understand it, Power Book 3, Raising Kanan, season 4, that came out in March. BMF season 4 is going to be coming out. I think it was supposed to premiere June 6th. Outlander, which I think is a show that hasn't been around for a long time, is going to be coming out in August. And then Spartacus is going to be premiering this fall. So what Starz would have you believe is that this is a pretty good setup of what they call tent poles of new seasons coming out that could generate interest and reboot new subscriber growth, which I imagine would be positive for the stock. But I'm curious if you have any thoughts on these shows or their new season strategy in general, and how you think that'll impact the stock, and whether we see some good performance going forward.
Sure. So I think what Stars has going for them, as you laid out, is that we're coming off of a lull of a lack of content because of the strikes, the multiple strikes in Hollywood. So for that reason alone, they're going to have more than they had before. I think a macro issue, and this is something not to foreshadow, I think is an issue when you're looking at how to value a studio that puts out movies versus a network that puts out shows, is that I think we also have to look at what is the addressable market for media. So I'm gonna take a step back. I'm gonna go 10,000 feet, but I'm gonna bring it right back down to earth. With media, the media that you're watching is competing for your time, and it's only 24 hours in a day. And I think a pressure that's not going to show up on the spreadsheet is just we are past the peak TV boom period of 10 years ago where there were just dozens and dozens of new shows that were just always coming out. The number of movies coming out, everyone's pulling back on the amount of new episodes, new series, new movies. So while it's more shows and content than they've had coming out of the strike, it's still going to be less than what they had in maybe 2019 or 2018. So I think we can be very careful that a lot of historical comparisons year over year are not going to necessarily apply. Now, in terms of the different franchises, I would say the franchises have a wide array of, I think, shelf life. I think so. Let's just go in order. So the Power universe, I would say, is their most important franchise by far. By far, I actually think the Starz management team actually probably plays up their women audience when it's really the crime dramas. It's either family crime soap operas, that tried and true formula that is really driving the channel. So with Power, Power had about a good, I want to say maybe 8 or 9 year run in the main universe, and they had a series of spin-offs using the same characters that came from the main universe. So I think we're coming to the end of the spin-off shows from the main Power characters. What we also have with Raising Kanan are some prequel shows, which don't have the same actors. It's almost like a brand new series. You don't have the same emotional attachment. Where I think there's opportunity for Power is they just announced a new show, not coming out anytime soon. They just got a writer's room that is going to bring back some of the male leads from the original Power show. So I think the most exciting Power show that they have coming out is not even currently on their schedule. So maybe 2026, 2027, you could see some growth from Power. Now, Outlander, as you mentioned before, that is an older franchise. This is a prequel show, new actors. You're not going to have the same audience allegiance. In the investor deck, they've talked about P Valley. That show has been off the air for a while, and it never was nearly as big ratings wise as I think its cultural footprint might have suggested. A lot of shows get way more chatter on Twitter and in the Atlantic than they actually do in terms of viewership. So, and BMF, Black Mafia Family, which I think in many ways is just a lesser version of Power. I think in some ways BMF actually kind of dilutes Power because the show is just so similar. But it's has an audience. So overall, I feel just sort of okay about the slated programming. One thing Starz has going for it is that they differentiate themselves by having explicit content for adults, mature content that has stuff that while you can see uncensored things on Netflix or HBO, they might not show, some of the sexuality and some other things in the same way. Their R-rated version of a Star show is very different from an R-rated version of a Netflix show. So I think that Starz has interesting strategy. They have franchises that still have value. Pixar just came out with a movie this past week that was a flop that got really great reviews, but is another one of the examples of how, despite what audiences say, they love going back to try and shoot franchises. So I don't want to write off Starz' franchises. I actually think doing a season 4, a season 5 is the right strategy. I would say to your listeners and to your readers, Starz, without saying so, I think has actually done a little bit of about face, which I think was the right decision because, and again, Starz never came out and said this, but what Starz said last year to investors was that, we actually, our shows such as Power are getting too expensive to do past season 3, 4, or 5 because the cast wants raises and whatnot. So we're going to cut back on that. We're going to do more prequels. We're not going to go past season 4. That was the message they were literally giving to the street. And the actors on Power were talking to the fans on Instagram saying, hey, this is why our show's not coming back because they don't want to pay us. So I'm very glad that they did an about face. And now that they're, going along with their franchises, but it's remains to be seen how much juice is still left to squeeze.
Makes complete sense, and it is. I did hear that because there were a bunch of transcripts
Yes,
published where they were talking about that how after season 3 or something it gets more expensive, and I
right.
was wondering why that was, and it makes sense. The actors know that they have a little bit more leverage there, and then it's an interesting point that Starz is focusing on prequels, and so prequels are good because theoretically it's the same show, but you have new actors that don't have the leverage that are going to force you to pay up. But at the same time, like you said, there's no emotional attachment for somebody who's watched the later seasons. So that's really fascinating. One other thing I wanted to chat about is just bundling. So bundling is another thing that the management team has really touted, and I think they've recently announced bundles with, I think, Vizio and Roku and Amazon Prime. And I guess the bull case, and I am by no means a bundling expert, but I look back and I think at one point last year when HBO Max was really pushing its bundle with Disney, I think like 20% of new signups were coming from that bundle. And then versus right now, I think for Starz, I think about 1% of revenue comes from bundles. So I'd be curious to get your thoughts on bundling as a strategy and whether you think that's a viable way for Starz to grow.
I absolutely think bundling is a viable way for Stars to grow. I think bundling is, frankly, probably their best strategy going forward. I would also add that while maybe not bundling per se, bundling in in effect in another way, I would I would tell your listeners to check out what's going on with Amazon Prime Video channels. So Amazon Prime has their own streaming service. Everyone's aware. They about maybe a year and a half ago, they flipped everybody to the free ad support tier, and they made you opt out, pay $3 or $4 a month, get ads. So they have a very large video service, but what people don't appreciate is that Prime Video has a lot of add-on channels that you can add to your package a la carte. It's almost like replicating the cable bundle. Roku does this as well. Other video aggregators do this. I consider this bundling in a sense where you're still riding on the coattails of a larger service. I think this is the best strategy by far for Stars because it helps smooth out some of the seasonality and some of the risk, some of the audience risk between the shows. Because I think when you think about valuation, the way you get a higher valuation for your business is you need to increase the certainty behind the cash flows. And the way you increase the certainty behind the cash flows for a network is you reduce churn. And I'm very bullish on their ability to strike some bundles, particularly because Roku and Amazon and all the aggregators, it's very profitable of them to do so. So back in the days of the cable bundle, um, everyone knows about the tension between the cable companies and the video providers because the video providers want more money for your ESPN and the cable companies, don't want to give them more money or pass on to you. They did not have that tension with the premium channels, with the HBOs, the Showtimes, the Stars of the world. There, both parties were in complete alignment because now I'm just going to use some pre-discount prices. Let's say in your cable package, you were getting Stars for let's say $10. It was a sticker price. Well, Stars would have a deal, let's say, where they would give, call it $3 or $4 of that straight to Comcast and then they would keep the rest. And for Comcast or your cable provider, that was pure profit because the marginal cost of offering another channel was almost nothing to them. And there was no fight, unlike when the cost of some of the basic cable channels would go up in the package. It was clear to everyone this is what you're paying, and they would divvy up, and it was in everyone's interest to try to grow the premium subs. Now the profit motive is similar for the digital bundles, Roku, Amazon. I don't see their internal books. They don't break it out, but I'm sure they're making great margin having hundreds of channels that you can just add on as part of your Prime Video bill. It lowers churn. You don't see it. You only see one price, so you might not even be price sensitive. I'm not sure what the split is in the digital package because while the total costs might be lower for digital. The split might not be as high for the cable channel. So I can't really speak to that. I think that just going off the financials, the effective ARPU, the effective rate that Stars is getting is between $4 to $5 a sub, I would say. And I think candidly, for the number of shows that people watch, that's actually, I would argue, pretty high. It actually makes Netflix and Disney and the other services look very, very economical. But that's the beauty of bundle. you're able to charge more for a premium add-on and get less pushback because the consumer in their mind is evaluating you as a component in the larger entertainment package. So I'm bullish on it. If you see evidence of bundling, I think that's a sign that the stock is going higher. But again, they have to get people to pick them every single time. You're going to see a lot of these promotional deals are tied around the premieres of when the shows come. So you're going to see a lot of promos around Power and BMF. So stay tuned for that. But I think riding on the coattails of Amazon Video is probably their best hope right now. Roku as well.
Yeah, that makes a lot of sense. The way that they pitch it is that you share promotional spend, so it's good, and then the churn is a lot lower, which also makes a lot of sense. So yeah, the bundle is coming back, right? Bundles, there's an opportunity to debundle, and then everybody bundles back. So makes complete sense. Now, I know your primary focus is on strategy and how the strategy plays out, and I think your take is that the strategy in Starz' secular future is definitely in question, and I think that's reflected in the stock price valuation. How do you think about valuation? What's the right way to think about valuation for Starz? I know you said I think the stock's around $16 right now. I think you said it could be anywhere from $10 to $20 depending on how you think about it. But I'm curious how you think about Starz' valuation.
Sure. So, okay, so I think in 2025, I think you have to be careful not to rely too much on historical comps for
Hmm.
any cable, any media assets, but we're talking specifically cable channels and networks. It's very tempting to look at historical M&A comps because there are so many of them, and they are very high profile deals and made names we know. But the reason why I think the historical comps aren't relevant is because the addressable market of the pay TV ecosystem is, call it, half as big. I'm talking US right now. The number of pay TV subscribers to what you would consider the traditional cable bundle, about, call it, 10 years ago in 2015, 2014, 2015, it was about 100 million households was fully distributed. Now that's closer to 50. Okay. If you want to be generous, you could say it's 68 if you're 70 million, if you add in some of the skinny bundles or the smaller packages, which leave out channels. Okay. So the historical comps don't work. I think you have to try to look at this as, what would I pay to own this business outright? And for me, that multiple is enterprise value to free cash flow.
Hmm.
You have to look at enterprise value because the debt matters, especially with 3 turns of debt. The debt holders might be the equity holders, so you can't ignore that. And I want to look at free cash flow because there are going to be some nuances to EBITDA that matter here. So first of all, I think Starz is going to get a discount just because of the lack of disclosure and the lack of precision that management has been giving. From what I've seen, management has not put on paper any specific detailed forecasts. I've had to get all of their forecasts through commentary on conference calls and whatnot. So they're trying hard not to. I think it's not the best sign that management has only been giving a $200 million EBITDA target for next year and a 1 to 3% revenue growth target as their rough barometer. You sort of have to build your own estimates. Here's how I think about it. Starz wants to tell you that they convert about 70% of their EBITDA to free cash flow, which is true. I also want to point out, and this gets left out all the time, Starz has about 200 to $300 million of NOLs. Okay. So they have a lot of untaxed cash flow that you have to adjust for. Now, this is outside the scope of my service and I think valuation. You could do a very detailed model to value the NPV of the NOLs. I'm not even going to go that far because it's an open question of whether or not Starz would even be around long enough to have $200 million of profits. It would be a long NPV, but let's just put some pen to paper and use real numbers. I'm going to give them credit for the full $200 million EBITDA target. Management is saying that the current 15% EBITDA margin can go up to 20. because they say that no longer tethered to Lionsgate, they can get savings on the cost of content. While I think that might be factually true, I don't want to give management credit for that because at the end of the day, what you pay for content is what you can bargain for. Your content costs go down when you're a smaller entity. I don't follow that logic at all, and this is where the strategy comes in. So again, your audience can build their own model. I'm not giving them 20% margins. Let's assume we stay at 15%, $200 million, and this assumes the revenue stays flat, which is an open question. Because let me say quickly about working with management teams. Management teams always skew bullish. Everyone should know that. If they're guiding you towards 1 to 3%, they're really hoping to be flat. Okay. So if you're hoping to be flat, we're in melting ice cube territory. I can't give you more than a 10 times multiple. That's just me. Until we prove that you have some organic growth. So just use some rough numbers. Let's say $200 million in EBITDA. I got about $36 million in interest, 6% off of 600 million. I might be a little bit off, but just directionally, I was going to keep going. CapEx, they've given scant details. They say that it's non-existent, which is probably true, but I'm gonna call it 10 million. They did, I think, 13 million trailing with Lionsgate. I'm gonna put more of the CapEx on Starz. Let's call it 10 million. So that gives me about 150, 154 profit before tax. I I gotta be conservative. Let's fully tax this because also too in the M&A scenario, which is probably not going to happen, but if it did, those NOLs are not going to go over in an M&A scenario. So I think it's better to pretend they're not there. Okay, so that gets me to about 100 million dollars in actual levered free cash flow, which let's just sanity check that. That's about 50% of my EBITDA. 50% EBITDA to free cash flow conversion is about right for a low capex media asset. So $100 million free cash flow is my target. So if I put a 10 multiple on that, that gets you to $1 billion enterprise value. Okay. And you take away, I'm going to speed run this a little bit. You take away about 560 million in net debt, divided by, call it 16.7, 17 million shares. That's looking at about 26 50 a share. Okay. That's the high end. I've seen some price targets around 25. I see the vision. Okay. And now from there, I just walk it down. And if you go from a 10x multiple to 8x, because of how big the debt is, that gets you from, call it $26 a share to a little over $20 a share at nine times EV to free cash flow, and about $15 a share at 8 times, and at 7, call it 850. So wide range of outcomes as they delever. That adds more value to the equity portion. But again, it's a little bit of a prisoner's dilemma, because the faster you pay down debt, the less cash you have to be nimble, which I think puts the franchise a little bit more at risk. So to bring it all together, I'm between $25 a share and 15, between 15 and 20, between 15 and 25, between 10 and 20. I really wish that I was paying attention to my inbox in your newsletter, because I could have picked this up when it was closer to $10, $12 a share when the split first happened. But I think anything over $15 a share, you need to be cautious, and you need to have conviction that your organic growth is going to show up, because if it does, it'll propel you north of $20 a share. But until the market, I think, sees evidence that this has like some organic growth potential, it's going to have a hard time cracking 17, I think.
Yep. I think that's totally fair. Yeah, my thesis. I bought this one and I recommended it before the Lionsgate spinoff, and at the time,
Yes.
the Starz stub was at one point trading at a negative valuation, which obviously doesn't make sense. I think part of that was because there was some uncertainty as to whether or not the spinoff transaction would be approved and would take place. And then, initially it traded as low as 12. and then has shot up, after they reported earnings as high as like 20 or 21. I kind of think that like a bull case scenario is kind of 25 to $30. That's the way I see it. That's assuming 5 times EBITDA, 5 times free cash flow, price to free cash flow, not EV to free cash flow, of course. But I think what's going to matter, what's going to get it there is if we see signs of traction from bundling, revenue acceleration, if we see revenue growth, and then if we see sub growth, right? So I think it's just going to matter. The fundamentals are going to matter. The revenue is going to matter. The subs are going to matter. But I don't. But it's clear. I mean, you just look at the valuation right now. It's valued like something that has an unclear secular future, and I think that's probably appropriate. Okay, so Simeon, this was awesome. I love this discussion of Starz. I would love to pivot to Warner Brothers Discovery and get your thoughts there. I know this is a little bit early, but Warner Brothers has announced that they're basically gonna undo the Warner Discovery merger and basically spin off the streaming assets and the studio business. So I think again, you're a little cautious on this transaction, but I would love for you to just share how you're thinking about Warner Brothers and about the potential breakup over the next, I think, 12 to 18 months.
Sure, Rich. So as you said, it is a little bit early. I don't have nearly as detailed valuation thoughts. I think that this is definitely one where you want to wait until we have a tracking stock, until we have like the when issued, until we have a chance to separate the two businesses. Because while I've seen some positive reaction coming out of the business update, I think two weeks ago, I think some of that a little bit was just the overall market repricing some of the gloom that we had. But the stock as a whole it's had a little bit of strength recently, but I would just caution everyone that they're separating the business because investors do not want both halves of the business. So you're never going to get full valuation until we can separate the two. That being said, I think some of your readers might be familiar from the Joel Greenblatt. You too can be a stock market genius. They had a case study in there, a setup that spinoff investors, will be familiar with, where you have a bad business or bad co or a less desirable co, to be more inclusive of all different investor tastes. Something where really for debt investors, really, because they're putting all the debt usually on one of the two entities is going to get the majority of the debt. That's also probably the entity that they think is least likely to be covered in an M&A transaction. Just keep that in mind. On the Starz, not to revisit that, but where do they put the debt? It wasn't on Lionsgate, so anyway. But on this part, for Warner Brothers Discovery, rather, you have the CFO, the numbers guy, who's going over to the networks business, which is basically every network but HBO, which I think objectively is just funny in its own right, because it really drives home, oh yeah, these are really orphan networks. I think that could be, well, one, if that trade's really ugly, again, because no one wants it, you might get lucky and that could be a cool trade. There's that possibility. If they do a little bit of debt pay down, wait a year or two where the leverage isn't, I don't know what the target is right now, but let's say they get the leverage down a little bit, the non-HBO, the network spinoff could buy other networks, because there are going to be other, free range networks out there. You got Comcast, which is separating. Comcast is spinning off. I don't have the name. You recall what they're calling it, Rich? Did
The
they make the
names are
name public?
hilarious. I gotta list out all the names. I don't remember,
Yeah, I
but
know.
yeah, it's a funny
It's pretty
name.
funny. Yeah, but you know what I mean. So I was reading that spinoff, I think, is expected not to have a lot of debt on the asset. So um, there could be a home for a type of investor who wants the steady cash flows from the cable bundle. The cable bundle has been in continued erosion. In theory, it could bottom somewhere. I don't know where that bottom is. So there's a price for everything, but that clearly is less interesting. the half of the spinoff that everyone and their mother is going to be more interested in is going to be in the studios and streaming, where it's going to have HBO, the studio, the production, Warner Brothers, and the DC Comics, and all the movie making assets, as well as the streaming service, again renamed HBO Max. That could be interesting because Warner Brothers still is just a very dominant studio franchise. There's been some talks out there that Sony could be interested. Sony, I think, is a great case study for another day, another time, where they, in many ways, are a huge media conglomerate that never jumped all in to owning their own streaming service, and they did not burn billions of dollars over 10 years trying to outcompete. So it's possible that Sony, oh, who also made a lot of money along the way selling their content to everyone else's streamers, Sony could say, hey, we'll take Warner Brothers for the IP, for the studio assets, and bring that into our conglomerate. I just want to say, as a larger media philosophy, this might sound weird coming from someone who follows media stocks. I actually believe most media companies should not be public. I actually think most of them should not be public, particularly in video entertainment. I think the economics of being a public company just don't make sense. And almost all these assets should be inside of a larger conglomerate that does not care about their P&L. So I definitely see the studios and streaming asset being a potential M&A target. The only problem is you don't necessarily have to rush out and buy it because, again, this isn't 2015, this isn't 10 years ago. There's a consolidated universe of buyers. We pretty much know who all the big buyers are. Outside of Sony, a lot of the big buyers are going to be the big tech companies who candidly might not be in a rush to buy some of these assets. So I think this is going to be a spinoff where it's very price dependent. I would say let's talk about fundamentals. While the networks business is pretty much going to be a math exercise on the decay of the cable bundle, we'll put that aside. On studios and streaming, I think right now with the Superman movie being in the zeitgeist and they're heavily promoting that, I actually don't think the upside is really going to rest on the superhero franchises because remember, as I was saying before, the theatrical market is permanently smaller than what it was. Even if Superman's a hit, there's going to be fewer movies that gross less. They did a great job with Sinners and Oppenheimer and whatnot, but you really can't build DCF on that or put like a terminal multiple on that. I think the real upside comes from the more TV side, and that comes from Harry Potter. I think a Harry Potter television show is the perfect media asset to build a streaming service around. It's something that touches lots of different demographics. Okay. We know that this time around, they're going to be stretching out the series. A big problem, a big reason I think that streaming churn is so high is because the turnover in the shows are so high. It's harder to churn when you finally have a franchise which if they stay on schedule, hopefully, and there's no strikes or anything like that, you could have a season, a book. So 7 seasons, 7 books. They probably will try to stretch out maybe the last one. So call it maybe 8 to 9 seasons. So that's 8 to 9, maybe a decade worth of must see content with continuity of cast. Oh yes, that travels. And I was talking with someone on Twitter. We could argue all day about what Harry Potter means to Gen Z or to younger people. Despite how I might look, I'm an older millennial. I'm 39. I was there when Harry Potter first came on the scene. I think sometimes people write it off because some of the controversy around J.K. Rowling. But let me tell you, Harry Potter still is the number one selling piece of not of fiction of all time. They still have theme parks all over the world. I think there's tremendous upside in the Harry Potter series in giving people a reason to stay subscribed to HBO Max for the entirety. Because as much as people might like The White Lotus or The Last of Us, you can wait a year or two for in between seasons, and you could never build a bull case on that. So I hope they have some success with the TV side, and maybe I'll come back with more of an opinion when we get closer to the split and we have the different prices. We can see what investors are looking at. What half are you excited about? What are you thinking, Rich?
So the thing that is a little interesting to me is that they're going to put the crappy asset, they're going to put $30 billion of debt on it. And so if you take the Warner Brothers enterprise value today, I think the enterprise value is 70 billion or so. And so if you just say if they're able to go forward with this spinoff and get the debt holders to sign off, which I think they're making progress on, and you assign an equity value of 0 to this linear spinoff, at least you're going to get rid of $30 billion of debt. And so the question is with the RemainCo, I forget which asset's going to get spun out, but you're going to have the streaming business and then you're going to have the studio business. And so what is that worth? And I've seen some of the parts that say like, 10 times EBITDA multiple is reasonable. And I've seen other studios have sold for much higher than that. Obviously, Netflix trades at a much bigger multiple in terms of streaming companies. So I think it looks interesting just because they're going to load this spinoff up with so much debt. So you're going to get rid of at least there's going to be some equity value. So maybe it's $5 billion, maybe $10 billion on the high end, but you're going to get rid of $30 billion of debt. So that accounts for a big portion of the enterprise value. And then, you just gotta get comfortable with, or what do you think the streaming business and the studio, is worth? My initial sum of the parts. So I was thinking that, let's say the spinoff trades at about 5 times EBITDA, and then the studio business and the streaming business trades at about 10 times EBITDA. I could get to like a $15 price target. I think the stock's right now at about 11. But that's kind of rough math, back of the envelope, some of the parts. Like I need to think through that a little bit more. And then there's the other thing that, like you said, this isn't going to happen for at least a year. And oftentimes there's like spinoff purgatory where a spinoff gets
Right.
announced, everybody gets excited, the stock pops, and then you just kind of forget about it. And so, oftentimes there's opportunities, people get disappointed, they'll have a bad quarter and the stock will sell off, and maybe that will be a good opportunity. But I'm intrigued. I think it's interesting. I don't own the stock, but I think it is interesting, and I'm going to be spending some more time on it. When you talk about the Harry Potter franchise and how that could be valuable for HBO Max, really resonates with me because I'm one of those people. I think HBO has the best content. I love White Lotus. I love Mayor of Easttown. I liked, what was it? True Detective. Like, I think they have the best shows on TV, but I just churn, right? Like, I'll watch
Right.
season 3 of White Lotus and then I'll churn. And whereas Netflix, I never churn because my kids watch Grizzly and the Lemmings, right? My wife watches some shows. Sometimes there will be some shows that I'll watch, and it's like I don't think I've ever churned off Netflix. Whereas HBO, with arguably much better content, I churn all the time, or I wait for a special. And so I think if they did have some sort of show like the Harry Potter franchise, which just made you keep it because your kids want to wait for the next episode, I think I agree that would be a super smart strategy. So maybe they go ahead and do that. One I know we've been talking for about an hour, so I'll wrap it up soon. But I guess how valuable, as a media guy and a media expert, how valuable is the Warner Brothers studio? Because I've been spending time looking at the Lionsgate studio, and I think it's like the 7th or 8th biggest studio. And the pitch is that, hey, it's the only independent studio that hasn't been gobbled up by one of the big guys or the tech players. Is Warner Brothers like truly a premier studio in your opinion?
The short answer is yes. I
Yep.
think it truly is premier. I think the question that we're all trying to figure out is what is the value of being first or second place? What's the value of premiere? Because as you mentioned, anyone could go up and pull up the list of studio comps. I think that if you then do your own math and ask yourself, okay, which of those studio acquisitions would you qualify as a success? At what price, then it gets really, really murky. I think that if you look back to the the initial merger of Disney and the Fox, the 20th Century Fox assets, I would argue that probably some of the most overvalued assets probably were the studio assets, which in fairness was based on an assumption that you had a larger pay TV ecosystem. And for the sake of this talk, I'm going to throw in the theatrical market, because so with television, you think about shows, you think, okay, the value of a show is how much I can generate selling it to cable channels, streaming services, here, abroad, etc. With movies, you have call it three or four windows. Okay. So and these are not the exact terms, but I'm just using it in layman's terms. You have how much money you can make at the box office. And then you say, okay, I have the window where they sell the movie rights to the, um, sorry, pay-per-view, pay TV, the HBOs of the world, and then they sell it to the public if you want to buy it a la carte. Well, I would argue all three of their windows have shrunk. Theatrical is smaller, and with the demise, and here is the reflexivity of media investing, where everything is impacting everyone else. The decline in the AMC's of the world. I'm sorry, that's the AMC movie theater, not to be confused with the AMC channel. Another spinoff which should have sold years ago, but that's a topic for another episode. With fewer movie theaters, then Warner Brothers earnings power is just always going to be smaller because there's just less places to sell Superman, and that's just a fact. So I do think I think with studios there is a value to being number one and number two. I think the value falls off drastically. It falls off a cliff as you go to three, four, five. I do not think the public cares if you're independent at all. The public says a lot of fancy stuff about how they want new stories, and we don't want corporate media. And yes, you have the Blumhouses of the world, the A24s, the smaller studios that will catch fire and do well. But Warner Brothers, I think because they have the big tempo franchises and probably maybe the best library outside Disney, I think there's still value there. But I would just caution everyone, look at how it turned out for Amazon when they brought MGM. You know, I haven't heard a single analyst, research, man on the street, a media reporter. I've heard no one say anything good about the MGM acquisition. The only thing I've seen have been headaches, headlines about the headaches that Amazon has had in their inability to get new James Bond movies out. But I don't want to get too into MGM. I just want to just make the point that studios are very complicated assets, and just because you have a great back catalog doesn't mean it can work out. I think Amazon MGM is a cautionary tale, but it's also an example of why these should not be public assets. They shouldn't. And so I wish the streaming studio spinoff the best of luck. I hope they can find a home as fast as they can, because every year more theaters shut down. Every year more viewers are shifting their screen time over to YouTube. And I'm not talking YouTube TV. I'm talking about just regular YouTube. Every year, more people shift more of their time to gaming. So there's just less and less hours on the clock for Warner Brothers to sell you content. And I think they're going to be probably in the game longer than Lionsgate, quite frankly, because what Warner Brothers has then going for them is that they have both the movie and the TV side of the business. So while I just went on how the theatrical market is probably permanently smaller, you have a market for all these digital channels. So and Warner Brothers still has tons of hit shows that you watch in other people's services, like Ted Lasso, which is on Apple, and Abbott Elementary, which everyone loves, is still on old school TV. So yes, I think Warner Brothers still is a great asset. If anyone has a future, it's them and Disney. But man, they gotta get out from underneath the cable networks fast. They need to get some traction. I know they really want to get this new James Gunn superhero universe going because the goal is they want to get the best story they can have for 2026, 2027, and maybe 2028 because time is not their friend. That is sort of the viewpoint that I have. And that's why I think that these next 12 to 24 months is really going to be a make or break period. And it's going to set up whether or not they can be acquired for a good price at the end of this period.
Awesome. Well, Simeon, thank you so much, man. This was really fun to chat with you. Really great to get your expertise on the media landscape and upcoming and current spinoffs. If people want to get in touch with you or follow along or get your analysis, what do you recommend they do? I know you're active on Twitter. I know you have Substack. Where do you want? Where should people go?
Sure. So if people want to see my work or follow me, you can find me on Substack. My Substack is called Accrued Interest. You can find me on Substack, the only Substack with that name, and then on Twitter, Accrued Int. On Twitter, on YouTube, the Accrued Interest podcast on YouTube, and I'm also on Instagram at the same name. I have my handles everywhere. I'm going to be building out the research side, giving more. I'm going to be giving trackers and bi-monthly updates of multiples, so everyone out there can see different ways to value companies. So thank you for the opportunity, Rich. This has been a great time. Hope to be back soon, and this was a lot of fun. So thank you.
Yeah, thank you, man. There's a lot of spinoffs coming in the media space, so hopefully we'll have you back in 6 months or so once some more details come out about the Warner Brothers spinoff. But really appreciate the time, Simeon. Talk soon.